to get started. And Andrew, if you are ready, maybe the floor is yours, brother.
Okay, John, thank you so much. And it's great to see some familiar faces and hopefully meet some new people. So, my name is Andrew Romans, and I'm the founder of 7BC Venture Capital. Many of you may know me from Rubicon Venture Capital, which I founded, and we're rebranding ourselves as 7BC Venture Capital. We try to think more and more about how to involve angel investors in our business as well as large corporations and family offices. And so I'm going to talk about our firm, but also about some very specific mechanisms we've put in place on how to involve and even compensate some of our angel investors that are very active in ways that we're doing that. So 7BC Venture Capital is the technology venture capital fund focused on funding and supporting tech companies, typically from some pre-seed, but late stage seed through Series A and some B. And then we do special purpose vehicles for allowing our LPs to invest on a deal by deal basis into the growth rounds right up until exit. And many of our larger institutional LPs, like sovereign wealth funds, and family offices, want to make direct investments, into the companies. Can you guys see me, or did the view just change here? I guess I
We
suppose
can
you
see
guys.
you. We can see you, Andrew.
Okay, perfect. So, yeah, so primary investment themes are artificial intelligence, kind of AI, ML, accessing data that's often not really been utilized, and kind of API that data and run it through this tech for ultimately running a business or a process more efficiently. So, automating human workflows, accessing this data for better decisions. And much of that is on the enterprise side, but of course, touches consumers. So we also have done very well in the past and will continue to fund consumer businesses and internet businesses that have very positive, unit economics and rapidly growing revenues that we feel our network, can support. And a little bit about how to involve the angels. So we know that most of the angel groups, we know most of the angel investors, we know they enjoy getting investing directly on the cap table, kind of doing their own due diligence, and so on and so forth, and all the way up until exit. And we think that a lot of time, depending on the amount of capital the angel has, they fail to achieve the level of diversification within a short enough time frame of, say, 2 or 3 years to begin to neutralize the singular risk of any single investment. And a lot of angels end up giving up a lot of their time charitably, either taking a board seat or being an advisor to a company that's struggling to raise more capital. And I jokingly say, if you're on the board of a company, the company should at least be able to afford paying for the dinner after the board meeting and not ask you to pay your own way. So what we've done is we've started to put in place almost infrastructure or specifics on how our LPs, be they angels, family offices, or large corporations, or these SOV funds that want to make some of these growth investments, can access the actual deal flow and meet with the founders more easily. So we've created a small pool of our carry, which we're willing to share and compensate with angel investors that are taking board seats on behalf of our fund. So I once had a meeting with a large Sand Hill Road VC, I won't say their name, where the guy confessed to me that he was currently on the board of directors of 37 startups. So if you figure minimum 4 board meetings per startup, really more like 8, it's hard to expect that person to be prepared, present, and following up, at that. So I think for for the VC team to be on so many boards is really not effective. 10 is quite common, and it's really too much. And so what we've done is we've created a series of events, and especially in a post-COVID world, I think that Silicon Valley is spreading itself, wide across the US, Canada, and around the world. But we're committed to having events where we invite all of our LPs. So again, angels, family offices, corporates, and sovereign wealth funds, some institutional investors, to come in person and meet with the actual portfolio companies and the startups and the founders and senior team members. And we typically will, depending on the number of people, we've always just said not more than 1 minute. Everybody go around and introduce yourself. And then it's just kind of open networking with food and drinks. And I find these are my favorite events that I go to throughout the year, our own events. And we're doing 2 of them a year in San Francisco Bay Area, typically Palo Alto and SF. And then we do 2 a year in New York City. We typically do this one same rooftop location, with good weather. We're probably going to start doing one during South by and one not during South by in Austin, because that's becoming a bit of a Silicon Valley too. And we're probably going to start doing Miami, since that's where New York seems to have moved to. And then we do 2 a year in London, one in Singapore, one in Hong Kong. And we actually encourage all the portfolios to show up or send at least one founder to each one of these events so they can meet kind of the LP layer to begin to support the portfolio layer and make things happen. And typically when we're doing a Series A funding round, if we're leading, there's typically going to be 2 board seats for the VC fund, us, 2 board seats for the management, and 1 mutually agreed to non-exec. And we want to pull from investor LPs in our fund to take some of these board seats. And the mutually agreed to NED is a no-brainer for that non-executive director, but also in many cases for the fund. And for the earlier investments, there's not always a formal board, but you've got board of advisors. We're keen for our angels to be involved. So we're excited about our angels being involved in deal sourcing, due diligence, governance, taking board seats, advisory, or a full-blown board member. There's probably some kind of compensation for there. In some cases, they may become advisors or consultants to these companies, and depending on the given situation, there could be some interim management positions or even joining these companies full-time. And for that, there may be some direct compensation for the company, but in some cases, there's a little bit of our carry to kind of reward people for doing that. And in some cases, this could lead to working more closely with us, becoming a venture partner, or even a partner, full-time partner at the fund, or even setting up a 7BC venture capital fund somewhere around the world, even outside of the United States. The 7 for us indicates 7 continents, international, kind of a global ethos. A lot of our LPs are from places like Japan, Singapore, Europe, Brazil, South America, Canada, that can use their network, again, if we involve them, to be able to, kind of help these companies, grow internationally. So there's 2 funds that we're raising for right now. This is really Fund 3 and Fund 4. For past track record, our first fund is returned 2.66 cash on cash multiple on invested capital. And with every scenario we can play out with what we're invested in, now that that's fully deployed, we expect Fund 1 to deliver a 5x cash on cash multiple. So if you put in 100,000, you get 500,000 back. Fund 2 is doing even better, and we expect that to end up being not less than a 10x cash on cash multiple. So, 5x and 10x is kind of track record. We think we can do better with this next fund. So there's 2 funds we're raising for. One is basically seed to Series A with a little bit of growth. And the other one is a $150 million growth fund to invest into 9 companies that are already been identified and largely negotiated. So some people would call that a warehouse fund or an opportunity fund. And those companies have all kind of have revenues from 2019 to 2020 to 2021, growing typically 2x to 4x and even 7x growth. Some of them really took off during COVID, kind of like the Zooms of it, rather than the hotels or travel ones that struggled. And The pre-seed to A fund, I'll describe that now. We're basically putting 83% of the fund capital concentrated around 18 to 20 Series A investments, and about 7% of the capital is being used for our pre-Series A program, and about most of those are probably around the 100K monthly recurring revenue (MRR). So that puts them at about a 1.2 ARR, annual revenue run rate. And about 20% or maybe 30% of the pre-A investments will be raw seed. Might be committing to invest in a company where we know the entrepreneur and they haven't, established the legal entity or recruited anybody yet. And we've had good experiences with companies like Superhuman doing that. And I think that that'll be about 25 companies within a 2.5, 3 year period. So the diversification of 25 we view to neutralize any of that risk. We could easily lose 8 of these companies, could run out of money, and we're not going to break a sweat because we know 4 of them would return all of that money. One of them might return all that money, multiple times. So we think we'll have a high multiple on that part of the fund, but it's only 7% of the money. We are big believers in doubling down in your winners. Initially with this fund, some of these 25 would be existing portfolio companies from Fund 1, Fund 2, or this group of 25 investments, and many of them would be new. For us to invest in a lot of the Series C, D, E, F, that would probably be good investments, but it would damage our ability to exceed a 10x return that we're shooting for. So for those, we're creating SPVs, special purpose vehicles. And this is where having attended the events and meeting the entrepreneurs and the other people in the network is very valuable. So you should already be familiar with the company and be able to participate in those. And for an individual to put in some money into a late stage company that's going to exit within 1 to 3 years, if you make a 2x on that or a 4x, that's probably good for you as an individual, but not what we're shooting for with the fund. We are originally keeping our minimum investment ticket size to join the fund as 250K. And we decided we wanted to increase the support for the fund. So this idea of involving more people to support the portfolio companies and be involved in different steps of the process of, all the way to impacting the exit. If an angel only makes one phone call and that turns into the M&A buyer of the company or getting into a SPAC, that's very, very important. So we've lowered the minimum to invest directly into the fund to $100,000. And John and I were talking about this, and we decided we're going to create a separate SPV, special purpose vehicle, if investors want to invest smaller amounts. So we haven't decided for sure, but we're thinking to either make that 25K or 10K, which is our effort of recognizing the value of individual investors for whom 100K might not be suitable. So we're lowering it definitely to 25K, potentially to 10. I think 10 maybe doesn't really make sense for anybody, but we're going to try to figure that out. So another thing we're doing beyond these events is what we call shadow days or LPIR program. So for larger investors that are doing $5 million or more, which include banks and telecom operators and large conglomerates and family offices, and actually even as of this morning, a sovereign wealth fund wants to do it. We're saying they can rotate up to 2 executives working in our offices throughout the year. So they can do 3 months to 6 months in one office, and then we rotate them back to the headquarters. And this is interesting because it enables us to have better communication with our startups and the corporate. And a family office is often like a corporate. And the family office is often like a corporate, but can make quicker decisions. So, for example, there's an Indonesian family out of Singapore that owns 62,000 auto mechanic shops across the archipelago of Indonesia. If we find a company that could potentially be distributed through all those stores, if they're not really working closely with us, it's going to be hard to find that. And for some of the senior people, they don't want to be away from family and spouse and children for very long. So they can just kind of spend 1 week with us in San Francisco, Silicon Valley, maybe 3 or 4 times a year. Maybe, when we're going to New York, when we're going to Miami, we're going to London, we're going to Austin, we can let them know and they can kind of fly in and join. And so we welcome that, that interaction. Real fast in my own background, I joined the tech industry in 1993, right out of undergrad. I then went on to found a couple of different startups, had one IPO, one M&A, and one epic failure. So my network with VCs began with me as the founder raising venture capital funding. So I knew a lot of VCs going back to the mid 1990s. Many of these kind of associates are now general partners, or they're still general partners, like Tim Draper. And then I created something called the Founders Club, which was before the secondary market existed. We allowed VC-backed founders to swap some of their founder stock in return for ownership in a limited partnership, where we would have up to 25 deals. So basically, a founder could become an LP in a fund and put 5 or 10% of their stock and then get ownership in 24 other VC-backed companies. We had 47 VCs on the advisory board that were in it on the investment committee for deal flow. So the VC network got bigger than that. I spent about 10 years before that helping startups raise VC funding as a non-executive director. So kind of investment banking for startups. So our VC network is deep, wide, and has been around for a long time. So we've co-invested with kind of, a total who's who of investors. So typically, if we're coming in a company at the late seed, it's very simple for us to help grow the revenues of that company with that financing round, and then they're hitting their stride, introduce them to lots of Sand Hill Road VCs who then can come in on the Series A, and we're either leading and they're joining a syndicate, or they lead and we join the syndicate. So we're looking to invest in roughly 25 deals that are pre-Series A in this fund, and about 18 to 20 that are Series A, and maybe 5 that we're leading an SPV but out of the fund. And we think that this kind of portfolio construction and balance kind of takes the risk out but leaves the door open for upside. And that's how we think we're going to be getting these 10x plus cash on cash returns. So we could go into a deep discussion on technology, but I don't know if that'll eat up all of our time. I would say with that, maybe we take it to Q&A and even a roundtable discussion.
Thank you so much, Andrew. Yes, we will start the Q&A session. So please feel free to either jump in and ask questions, or put your questions in the chat box.
While you guys are thinking about that, I've also written a couple of books, and I know some of you told me you were joining this event and you'd read my books, or we've been in touch in the past. My first book is really just about venture capital. I think it's a good read for VCs or entrepreneurs. But the second book is more specific. A large corporation asked me to help advise them on forming their corporate venture capital unit, and I interviewed 20 VCs and got CVCs like Intel Capital, and got really deep into that topic. And I used that to advise that one large corporation. I then went on and let a couple of years go by and interviewed hundreds of CVCs. And that helped shape some of our philosophy and thinking of how large corporations, if they don't access startup innovation, they're going to be a victim, not a beneficiary of all of this tech that's changing, from AI to data being utilized for programmatic everything. And I think it's now not just Intel and Microsoft that recognize, and Cisco, that we're in the tech business. of the products we sell, we need to be accessing CVC. But I think every company, down to Campbell's Soup, needs CVCs. So that was part of a driver of how to involve the LP in what we're doing, and that's where most of our LP capital comes from. But we've actually got a big network. I've known John for decades, and so we're super excited at finding ways to involve folks.
Okay. Karen, I think you had a question. Maybe you
Yes.
can.
Yes, thank you. In terms of all of the seed funding that you do, what could you just review the what your requirements are and what you actually look for? Because I know that seed and Series A are going to be very different, but being that they are in early startup phase, like what are some of the minimum requirements that you have, and what will you not accept into the fund?
Yeah, I would say that we try to stick to some criteria for kind of over the wall deal flow. For existing relationships, we're willing to kind of break all of our rules and say, like when Raul Vora came to me after Reportive and pitched Superhuman, I committed to investing that before he incorporated or had the first employee. When Alex Moore, first employee of Palantir, we would just meet every couple of weeks for coffee in Palo Alto and talk about stuff. And before Node Prime had a name, I was committed to supporting it and try to play a hand in some of the vision or help with kind of whiteboard strategy. That's more of kind of our existing network, and that network is changing minute to minute, but I enjoy that. We just can't afford to do deep 2-hour strategy meetings with people we don't know. So I would typically say, so the short version of my answer to your question is, we like to see $100,000 of monthly recurring revenue, and we have a bias towards enterprise software and SaaS. But when we see companies with positive unit economics and really rapidly growing consumer deals, we'll get behind it if we think we can add value. But at one point, I thought about putting on our website, if we can't add value, we will not invest. I think that like one of our criteria in our memos is, what is our unique value add? And sometimes you could say, well, we can introduce them to all their next investors, but that's not very unique. So we like to have a reputation that we did something beyond writing a check that didn't bounce. That adds value to the business. If we take on a company that has really no revenue, it's hard for us to make introductions and have that begin to really take off.
All right. Yeah, SaaS, also known as Silicon Valley's drug of choice. Noel is asking, why do you look for 2 board seats? Isn't a single board seat sufficient?
Well, let me first say, and I guess the way I just introduced the fund and our strategy may have been misleading. A lot of VCs are obsessed with governance and board seats. We're not. I kind of think you can achieve the same thing by being helpful to the startup. And we're big believers in communicating with our LPs with minimum quarterly newsletters. And so we try to get tons of updates. I think the number one cause of death for a startup is running out of money. And so we try to obsessively keep our eye on what are monthly expenses, monthly revenues. Are they burning cash? Almost always. Are they generating cash? Sometimes, even for a short period. And then how much cash they have in the bank, and when would they burn out and run out of money? And when should we figure out how to lower expenses or get more cash in the door from investors to make sure they don't run out of money? We can do that without necessarily taking board seats. I find that a lot of the big Sandhill Road VCs are not so effective in their taking of board seats. So short answer, we don't need, we're happy with 0 board seat, can be okay. If we're leading the financing round, be it a Series A or a growth round where we have an SPV with some big money coming in, the term sheet may have 2 board seats for our fund, and we may have already agreed with the founders who from within our network are going to be taking those seats, either part of our full-time team or part of our LP network. I also think when you go to IPO a company, it may be good to move from the board to the board of advisors and bring in some kind of former CEO of Cisco type person that really puts together the ingredients for a very successful IPO.
All right. Please feel free to jump in. I'm going to keep on reading the questions from the chat box. Okay, so Luke is saying that he's raising seed funding, which is another topic. Andrew, this model of involving angel investors, LPs, etc., is this new to these two funds that you are raising, or have you done that in the past?
We did it in the past, but not at great scale. We were involving the LPs primarily through the investment opportunities. So, our accounting bill is pretty big with something like 70 SPVs so at Rubicon, I came up with a strategy of saying the fund will invest into deals and create diversification. And if there's room in the round, we will launch an SPV, special purpose vehicle, that we called a sidecar. So the fund would invest and we create a sidecar. Part of my analysis on this was that angel groups, looking back at like Angels Forum, Band of Angels, Sandhill Angels, New York Angels, could become problematic. That we've seen all these kind of Ron Conway, SV Angel, that led the way for a lot of institutional seed investors that are doing 3 or 4 investments per week and into very early companies. And if they have to make 3 to 5 investments a week, they were not doing an enormous amount of diligence on companies that had not been around that long anyway, to be harassing and not investing in. And that the angel investors would benefit from being involved with a fund that has custody of money, able to move quickly, and then bring the angels into a sidecar to populate this startup with more network to support them and make them successful. We did a good job of running the sidecars, the SPVs, but they were sometimes slow, or the founder would say, I'm willing, how much can you invest from the fund? And we say this amount. And then they would map together the entire round by the end of the week before we even sent out the sidecar memo. So I think we didn't do a good enough job of preempting an investment or committing to a larger check. I think what we can do now is we can basically underwrite. We can say, here's a $5 million check from the fund that fits with our portfolio construction, and we're going to send out a memo and allow for 1.5 to 2 million to come in from our existing LPs, including small checks from angels. So we've been at this since 2012, but I think we can do a better job.
All right. So my apologies to Luke. He was saying, he's raising a seed round, but he actually had a question, which is what industries are you investing in primarily? You may have or may not have gone into the details.
Well, so we're primarily passionate and excited about the use of AI and ML on various data sets. And so and then the overall digitization of workflows and human workflows. So that can mean business, but it can also mean other parts of the economy like healthcare and education and government. Notoriously difficult to sell into, and we recognize that looking at any deal. But I would say that financial services as an industry to apply this to, we see as making the biggest returns in the near term. So fintech is a primary investment theme, but general AI and automation across industries. And, we've done very well in the past in some consumer deals. So I would say for consumer deals, we really have to come in at the point where we can see the unit economics and we see rapid revenue growth, and we have some sort of value add through our network that we deserve to be funding that company.
Andrew, can you give us an example of a consumer deal?
An example. So three quick examples of consumer deals, and things that look very B2C often are more B2B than you think. But Daily Harvest, these guys make smoothies. There's an all-women team, which we were excited about, and we believed in it being healthy and convenient and subscription based. And these guys, we were in that at 30 million, and I'll let you do your own math, but they doubled revenue from 19 to 2020, that they had over 250 million in revenue, more than doubled, profitable. If you were to SPAC that, you could have a $2.5 billion valuation on that business, and we were in at 30. And then we invested repeatedly after that. This year, I can't divulge anything, but do your own math if they're flat, and do your own math if they doubled. COVID has been an accelerant to this company. Another one is Super Coffee. Super Coffee is like, refrigerated cold brew coffee that they put monk fruit into instead of sugar. So it's sweet with no sugar, with a little bit of protein. So you have that for lunch and jacked up to work through the day. And that it's really about the people. There are these three crazy brothers that run that business. And I was like, Jesus Christ, these guys are drinking so much coffee. They're so athletic. Like, I just would kill myself if I lose money on this. And that they've now got a deal with Anheuser-Busch as their exclusive distributor for the US, with a right of first notice on the acquisition. It is just impossible for that acquisition to be anything less than $800 million, and it could easily get into the billions. That's, I kind of fancy myself as this like Cisco tech next generation network guy. If it's not some kind of router session border controller, I shouldn't be in it. But when our network, I think it was Mark Cuban who brought that deal to us. They actually pitched him on that, crazy TV show, and we, which I can't stand watching. It's like being that rude to the founders. But we looked at it, we met the team and said, we think we can help. And I love those guys, and they're totally awesome. Last consumer deal you could say is Superhuman, the email. If anyone uses G Suite or Gmail, you should absolutely email me to get you off the wait list. This will totally change the way you do email. It's going to come out on Android and Microsoft soon. So their market share will be enormous. But just from, I get very excited about a consumer deal like that. But I generally like to see that the company has some proprietary technology that nobody else has. And we really saw that with Superhuman. Raul had founded Reportive before that. So we knew that he'd sold Reportive to LinkedIn for 15 million. And so I felt confident that this guy can raise money. He really had me at hello, that he can raise money. He's a technical founder. He's got the same skill set to make Reportive 3.0. And at the worst, he could sell it to LinkedIn for 12 million. And we've got downside risk protection of getting in at 8 in a total seed. So that round, also got taken up very, very quickly. An example of where the sidecar SPV just does not work.
Okay. And another question from Don. Any AI-powered medtech, biotech ventures in your portfolio or interest?
Not in the portfolio, but there's a guy that I've known for 20 years who just exited his second AI medtech company, is just committed to invest in our fund. And he's basically on a path to be a venture partner and then a partner, but we're just going to start working together gently now. Any deal flow we get in that arena, we would drive, to him right away. I actually have a med tech and biotech background from my Founders Club days. So NEA had Patrick Chung on the IC of the Founders Club when we were this equity exchange fund. And then NEA started making a lot of investments into Founders Club subsequent growth rounds. And when the medtech, healthcare life science team heard about this, they encouraged us and helped us get the equity exchange fund for med tech and biotech, where you've got like clinical trials, total risk of failure, FDA approval, stuff like that. So I spent a couple years learning a lot about that. And I had Mike Sheffrey, founder of OrbiMed, largest purely dedicated healthcare VC in the world, on the advisory board, and 9 others. So we're actually very well connected in that area. I traditionally think it's harder to make money, but I am excited about the capital efficient, non-total risk of binary failure AI companies. And so applying AI to a big industry, it's hard to get bigger than healthcare. So it's become something interesting. If whoever's asking the question is an expert on that and they were to work closely with us, that would be very much welcomed.
All right. Another question is from Noel. Do you look at deals in Europe? If you are holding LP and founder events in London, you must be.
Yeah, so a long time ago, I lived in London for 10 years, so I'm very well connected over there. And so I like to get back there frequently and keep my network alive. So I even do these big events where all the VCs and founders and bankers and lawyers can come and hang out. And I'll typically do like a 5 or 6 VC panel, give a talk about what we're up to, and then it's just like, wine, beer, soft drinks, networking, canapes, food. We are exiting a company where we co-invested with Draper Esprit, who we know really, really well, Talus Capital, Emory, Tom Vest, Rakuten. So that's a good matching basis. So I think at some point we will launch 7BC UK, and 100% of that bucket will go into British domiciled companies, and we'll differentiate ourselves of saying we can immediately get you to New York, to Silicon Valley, to Asia with our network. So long term, I think that 7BC will have funds in other countries that will tie in. I'm a little bit more motivated to do more investing in the UK now, to attract more investors from the UK so that we can make good on getting 50% matching as the anchor LP. So we'd like to. The truth is, I do find that investing outside of highly evolved ecosystems is increasingly dangerous, that there's a lot of VCs to keep funding your portfolio companies in the UK. That's not a big problem. There's just not as many big buyers other than PE, which is normally a little bit of a disappointing exit. Whereas in the US, we've just got so many big balance sheet buyers that are around our companies at the same time. And I think that can be somewhat mitigated by being a little more forceful on getting our British portfolio to come to our events. And that's why they should be taking our money anyway, that they want access to our network.
So I want to acknowledge the fact that it's 10:45. The meeting was supposed to, last for 45 minutes. We'll, if Andrew is okay, we'll go on. I have a hard stop at 11, but if some people have to go, what do they, what if they're interested? What should they do? Should they contact you, Andrew?
Yeah, so I'm Andrew at 7BC. If you've got me from Andrew at Rubicon, that works. So,
Andrew at
okay.
7bc.bc. Okay, great. Another question from my friend Peter Levy is, what, some people say VCs always invest, they only invest in their friends' companies. What percentage of your investments go to people that you know versus people that you didn't know before?
That's a good question. And, it even when COVID happened, we had COVID and a final awakening on social injustice. And if people are afraid of investing when they can't meet you in person, and they're relying more on their existing network, that's even creating more of a divide with, minority people that are not, connected into this kind of white system. So I think that's an issue we should all be aware of and make greater efforts to take at least a Zoom meeting or a meeting with people that are not directly out of your well-connected network. What I would have to do some analysis to give you a precise answer to that question. A lot of the deals that we invest in are people we did already know or were introduced to us from someone that we've known, like John, or an LP. My favorite way to be introduced to a startup is through an existing CEO. like bartender introducing us to superhuman. But I think it's important for many reasons, and even making for a better society and overall economy, to look at every single deal that comes to us. One thing I'm very unresponsive to is when somebody sends me an email asking for a meeting for funding via MailChimp or SendGrid. I know it's far more efficient and it should be the way we do it, but even if I'm okay with that, if they do that to the next level of funding, I know it's just not going to be looked on well by other VCs. And so raising money as a skill set is one of the things we look for in a good company to avoid this not running out of money death, thing.
Okay. I'm gonna let Steve ask this question. Steve Tsai, I think you had a question. Jump in.
Yeah, hi, Andrew. You mentioned about the value add that you're providing, and you gave some examples. I just want to contrast that with, for instance, Andreessen and Horowitz. They actually provide expertise in sales, marketing, business development in the various areas. Do you see that this kind of levels of expertise are you providing, because your stake is probably less, so can you afford that kind of an in-depth value add?
Yeah, so Mark Andreessen did so well from the IPO of Netscape, that it didn't matter that he sunk Ning to the bottom of the ocean. And when he went to raise his first fund, he was so wealthy that he required all the GPs to donate 50% of their income to philanthropy. And they were able to anchor the first Andreessen Horowitz fund with so much of their own money that they just got to billions of AUM so fast. So if you look at just the dollar value of annual budget of income they had from management fee alone before they got into carry, it was so big that they began to build functions in-house and provide them as a free service to their portfolio. So I remember seeing this with like first round capital, and then Canaan even bought a headhunting company in like 1998 and did free executive search to their portfolio companies. They got rid of that with the 01 crash. But I think if your management fee is that big, you can afford to bring these things in-house. They even hired one of my MBA buddies, Jerry McGurk, was working at HSBC TMT investment banking in New York City. And they said, we should provide that level of Wall Street investment banking for free to our startups. So they have all these different silos with all these full teams that work for that. Our management fees are so small in comparison. There's just no way we can afford to pay people full-time salaries to provide these free services that are so amazing and valuable to the portfolio companies. So as kind of a guerrilla warfare way of attempting to add value, we're doing it very differently, that we're lowering the minimum investment into our fund to a very low amount to try and get some of that expertise to mix and interact with the portfolio companies. So short answer, our management fee is not competitive with Andreessen Horowitz to spend, I don't know how much they're spending on an annual basis, but that would be more than all of our management fee.
All right, Gil Silverman, who says he's from Luca Ventures, a pre-seed fintech fund, says, how can 7BC as a firm with hundreds of millions of AUM have the time, resources, and intention to invest 100K at a time at seed and pre-seed companies that have to be nurtured for many years at low dollar levels? I don't think you do pre-seed anyway, but anyway, that's the question.
Yeah. Well, we think of 7% of our capital is for pre-A, 20 to 30% of that is actual pre-seed, but typically into folks that we know, or just someone we know really well is dragging us into it. It's actually the investment pace that I was hoping to have was to make this a $200 million fund, and 7% would be an average check of 150K, doing 25 a year. So we would get to 75 on our pre-A program over a 3-year period. We've had pushback from large LPs that they don't want us spending so much time with these companies. And so we adjusted that to be an average check of 210K to 25 companies over 3 years. But let me put it in perspective. If I were just arrived in Silicon Valley this morning and had no network and went to a YC demo day twice a year, where there's 100 to 200 companies pitching us, and then we start taking meetings with 20 to 30% of those that we like, and we invested in 5 per batch. So highly selected out of their 100 to 200, that would be 10 YC companies a year. That's already way too much with the pricing and all the safe and things I don't like about YC. If we go to Alchemist, which I love as an accelerator with Ravi, if we go to every Alchemist, we're in there, we're helping before demo day, and we know what's going on. We're putting together our own friends of VCs plus our own syndicate. To only do like 25 investments like that over a 3-year time frame is really suppressing our own personalities and network. Christ, if I just have dinner with John twice a year and have him showing me what he's up to, it's hard not to get really involved. Now, how much time can we spend nurturing them? It depends. If I personally have a chemistry with the individual, I don't worry about the money, and I'm just going to do what I can to help that company. The fact that we're in the deal for a small check or a big check, I try not to influence too much. If they're being very unreasonable, I'm easy just to say, all right, he's not taking our advice. She doesn't want our advice. Leave him alone. But the other thing is to have them meet all these interesting former VC-backed founders or currently VC-backed founders, or people that are at the large corporates that can help that startup. That's where we hope to try to deliver value to every single company that we meet. And for any company we invest in, we're going to help them with introductions to their next investors. And if there's nothing else, we know a lot of worthless roadkill venture capitalists.
All right. Alchemist rocks. Siva has Noel has another question about Europe. He says, since Britain has left the EU, what about deal flow from European tech hubs in Dublin, Berlin, Paris, etc.?
Okay, so I speak fluent French and German. I'm educated in Paris and Berlin. And at one time, I felt like I knew every single VC in Paris and Berlin. The CEO of BPI France is the equivalent of the BBB. He went to my high school at Collectif Bilingue in Paris, and has been in our offices in San Francisco. And the French government has hosted our holiday parties in the residence of the ambassador to the United Nations in New York City and in the consul general's residence in San Francisco with amazing views. And we're going to continue to do that maybe as early as this year or next year. So we have a special relationship with the French. And Germany has been harder for me. I speak German with almost no accent, but I find that Germans are honestly so nationalistic about propping up their own startups that the Berliner scene doesn't even want to invest in Cologne or Munich or Frankfurt. They're just like all about their babies. And so if we said we've got a German only fund, we're helping them get out, we might be able to raise money, but it's always been a waste of time trying to raise money. The last time I did an event in Berlin was for the Founders Club, where it was Equity Exchange Fund, which was great. But I was in Berlin in January of last year for Super Return. I love the country. I love Munich too. We've never invested in a German company, but we're not against it. I think that the more you invest many time zones away or far from home, the more it should be later stage. The more you invest early stage, the closer you should be. So if you need help firing a team, firing people, I can come and do that painful work that's necessary to save the rest of the company.
All right, Andrew, we are coming to an end. Thank you so much. Any parting thoughts? We have your email there in the chat box. If people are interested, what should they do?
Yeah, send an email to me, reference John and US Angel so we can track things. And closing thought is a VC should add value. The Andreessen Horowitz example is an amazing one. We don't have that much money, so I think we have to find other ways to add value and be good long-term members of the ecosystem.
Sorry
Right.
about that. Thank you
Great.
all. Our
Thank-
next US Angels meeting is next Tuesday, the 20th. Please be there. Have a great rest of the day. Thank you, Andrew. Bye-bye, everyone.
Thanks, everyone. Bye for now.